Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. And today my guest is Randy Smith of Impact Equity. At Impact Equity, they want you to meet your investment goals with Impact Equity, passively investing in real estate to decrease your dependence on W-2 income. It's a syndication show. Let's go. This is episode 231 of Zen and the Art of Real Estate Investing with my guest, Randy Smith. Randy is the founder of Impact Equity, and he brings over 25 years of experience in corporate sales and leadership to real estate investing. He launched Impact Equity in June 2022. They help investors place money across several different projects with world-class operators. Randy also launched Raise Capital Coaching and Consulting to help new capital raisers start their business. Also, he's the co-host of The Gentle Art of Crushing It. Randy, welcome to the show.
Yeah, thanks so much for having me here. I am excited to be here.
Yeah, no, I always like to talk to investors who've come from a different world and use those skills to do well in investing. But I think it's really interesting that your dad was really involved in real estate. Is that where you got the bug for real estate and you just thought about it later?
Yeah, I ultimately, yes, that's where the seed was planted. I do have a little bit of the rich dad, poor dad kind of background where dad was a cop in LA and he ended up buying apartments and did very, very well financially.
Yeah.
And then mom and stepdad bought a small business in Northern Michigan and very different story. So,
yeah. But did you go on site to the buildings when your dad was buying them, or you were too young or not interested?
You know, my mom and stepdad had moved us across the country.
Oh, okay.
By the time my dad started investing in those, so I just got to hear the stories.
Yeah, but that's good though. It puts it on the radar. So you lived in the more poor dad part, and then you were watching the rich dad, right?
Something like that.
Yeah. Just generally from the story, not of course in that. So when did you decide that whatever you were doing wasn't enough and you wanted to turn real estate into something that would be more of a full-time thing for you?
Yeah. So I was early 40s when it really finally got a hold of me. I always believed that you needed to have a lot of wealth, or you needed to have a ton of capital sitting on the sidelines before you can get involved. And you and I both know that that's not the case.
Yeah.
But that is one of those limiting beliefs that kept me on the sidelines for a lot of years.
Yeah. Why do you think? Was it just because of obviously there wasn't as much social media, which is good and bad now with what it exposes to people who don't have a ton of money to go. But why did you feel like it was too early to take the leap?
You know, I chased the corporate dream for so long. Yeah. And there is, kind of groupthink in that space where, if you just work hard, you work a gazillion hours and chase the next promotion or the next new job.
Yeah.
If you invest heavily in your 401k, you're going to be okay. And most people don't talk about investments outside of 401k investing in corporate America, at least my experience anyways.
Yeah, I started working for the government. That was my first job out of law school, and I worked for the government for 8 years. But because of my dad, who was always investing on the side of an attorney business, I was just investing, but I didn't think I was a real estate investor. It didn't even cross my mind because there was no platforms or anything telling me. I just thought that was something that I do on the side. So it's interesting how you end up coming to it based on it. Was there a time in your corporate career where you realized like, wow, there's a ceiling here. The ceiling's not going up. I need to do something else to make it have an unlimited part up there.
Yeah. So mine, it was kind of interesting. So I did very well as a salesperson, but you always have this kind of, this thing that's like gnawing at you that you got to chase the next promotion. And, for me to move to that next promotion meant that I was probably at, director or VP level, which meant I was going to be traveling like crazy.
Yeah.
And real honestly, I was making more money than a lot of my bosses and even potentially my boss's bosses.
Yeah. Yeah.
So yeah, it hit me at one point that I either need to promote or I need to find some other way to kind of keep my mind occupied because I was starting to get bored in that role. And that's when I started looking at it. And frankly, I was doing those calculators about, if you keep on the same trajectory you're on and you keep investing in the same amount, this is when you can retire. And that was not a path I wanted to go down.
Yeah, it also sounds like the time versus value thing was starting to dawn on you. Like you could get a higher role, work more hours, but the sales is salary plus commission, so you can do even better staying at that. But you also have no free time, so it's
Exactly.
like how can I get also some time freedom along the way?
Yeah, and that's a big piece of it. So, you've got financial freedom, time freedom, even just kind of autonomy in your role.
Yeah, for sure.
And as a sales guy, you get tons of autonomy, but as you move up, you get less and less autonomy, and your calendar consumes you as you promote. So
yeah. So what was the first step that you took? Because it's interesting there's people who got in early, like myself, because my dad was just doing it and I thought I was doing it. But you're, around 40 when you get in. And a lot of people think, oh, it's too late for me. So this is another good reminder, like, hey, you can just pivot and make a choice. So what was the first thing that you did to start to move toward real estate?
Yeah, so I read the little purple book that everybody references and started listening to Bigger Pockets like everybody does. And,
that
Bigger
works.
Pockets, it does. It absolutely does. And being a sales guy, I was managing territories, so I'm driving all over the place and had tons of windshield time. So I would listen to 3 or 4 hours of podcast a day. And, it's kind of funny. Like, I think what's interesting is Bigger Pockets is there's so many different strategies that are shared. So if you get attacked by the squirrel mentality, you can go down a million different things. And honestly, I was listening to a podcast one day and I heard a turnkey single family operator on another podcast and just called the guy up and said, this is the time. Went home and told the wifey, I think it's time that we jump in, and this will, only cost us 25 or 30 grand to get started. And we were off and running.
Yeah. And did it sound, choosing turnkey as a first investment is smart. It's generally passive if you get a whole system coming along with it. And I feel like I've been saying a lot now. I think there's a lot of people who right now, because of what it costs to buy houses, they're going to probably just dunk into turnkeys instead and still rent because it's better, a better option to rent. So it's kind of like these strategies that you use to get started really could come back and help people now as well, because it's just harder to buy a regular single family home if that's what people are looking for.
Yeah, and I think there are some very large-scale professional turnkey providers. I know a handful here in Arizona and some on the East Coast that are really good options. They provide pretty decent cash on cash, and they're in appreciating markets. So over time, that asset's going to appreciate in value. So
that's really the long-term mentality. When you look at turnkey, you have to think like, hey, let me grab a market that's also going to appreciate. So this $200 a month will steadily go up, but also my out value is going up all the time. So I have equity if I want to repurpose it along the way.
Yeah, and I think that strategy works. I went the other route where I invested with a not so reputable company. I found out after the fact. My due diligence was terrible.
Yeah.
And I was buying assets that were, old, tired, what you would expect in like a BRRRR or a flip situation.
Yeah.
But he wasn't doing the quality of renovations that would need to be done to make this thing cash flow for years and years. So you buy a turnkey or out of pocket 25 or 30 grand, and then you get an $8,000 bill for a roof in 6 months. Like that kills your cash flow for the next 6 years.
Yeah. Do you think that you were short on the due diligence just because you were so excited to take action, which is, is still a learning lesson?
Yeah, no doubt. There were all kinds of mistakes that I made on those first investments. And like the biggest one that really kind of comes to mind is you always hear if you're buying a house, get an inspection. And he came to me and said, hey, we already do inspections and you're more than welcome to get your own inspection, but here's mine that you can use as well. And I'm like, gosh, he's such a nice guy. He's already done the inspection. Why would I waste the $300 or $500 on an inspection? Well, I can tell you exactly why you should do your own inspections now. Definitely.
Yeah,
So,
absolutely. I mean, that's just a good tip for everybody who's just someone who wants to make it easy. It's always worth spending that little amount of money, even if it turns out that you find something big and the deal fails. That's good. That's a learning lesson there.
yeah, absolutely.
Because if you would have found that 8K roof, you're probably still hopped up. You're going to close the deal, but maybe you get a 4K credit, so it's a little bit more, palatable later.
Absolutely.
So, how did you eventually pivot from turnkey real estate to syndications? Because I know you started out investing as a limited partner in a lot of things, which again is another thing that I think is going to be a very good alternative for high income earners now who are in rentable cities and they maybe get job transfers. They really don't need to own a home. So these are great opportunities for them.
Yeah, so I took one other step before actually moving into passive investing. I ended up figuring out through that process I wanted to have more control. So I ended up moving over to the BRRRR strategy into a new market. So I had bought turnkey in Kansas City, and then I did BRRRR strategy in Atlanta. And we did the really, really ugly house on the block.
Yeah.
Like full gut rehabs in not the nicest areas, but areas that were starting to show some positive trends and signs. We bought a handful of houses out there. And I mean, we could do a whole podcast about challenges that I had with doing BRRRR out of state.
Yeah.
But at the end of the day, our timing was perfect. And we took control of a bunch of assets and everything was rising. So we did extremely well on those handful of properties out there.
Yeah.
But at some point, I realized that the amount of time, energy, and effort that I was spending flying back and forth to Atlanta, talking with contractors and realtors and all property managers, all that other stuff, it was pulling me away from my job where, it was very clear to me, like if I spend X amount of hours, I can make X amount of dollars. And that was a lot more than I was making on the real estate. So I decided that I wanted to scale. I started looking at call it small multi, so 8 to 10 to 15, 20 unit apartment complexes.
Yeah.
And I actually was about to put an offer on, at the time, I think it was like a 20 unit. I kick myself now for not doing it. It was like a 20 unit for $1 million. So
yeah, that sounds pretty
cheap.
solid.
Yeah. But I kind of backed out last minute because it just scared the hell out of me. I'm like, you buy $100,000 houses, 25 grand down, big deal. But $1 million acquisition, that's going to look a lot different.
And 20 units to manage seems like, oh, that's not too many until you try it.
Right. And going, what did we have, 6 doors at that time to buying a 20 unit? It was too big of a leap, I thought. So I had started hearing about passive investing from, the guy with the beard on the podcast and decided that I would invest passively in a couple of deals just to kind of get a peek behind the curtains and see if that was something that I wanted to do in the future. And I peeked behind the curtains and saw, gosh, this is really complicated. And these guys are doing really good. Why not just double down and invest with other professionals and experts that do this full time?
Yeah.
And that's kind of how I got started.
Yeah, I love the term that you said, peek behind the curtain, because I thought of it that way too. I was like, well, I'm not really interested in doing multifamily for the same reasons. It's a big chunk. I don't really want to manage it. I don't want to manage the manager, but wait, what if I could just get a part of a couple hundred units and then look at all the, deliverables that they send, figure out maybe it's something I want to do later. Maybe I just get comfortable trusting the operator to do what they said they're going to do and learn that way. And I found it to be an incredible resource of just learning about multifamily by investing as a limited partner, especially because I can have no say. And for control freaks, it's actually really good. There's nothing I can do. I'm not going to have any impact on them. Even my friends who are running them, I can't change anything. So it kind of gives you that opportunity to say, this is long-term. It's illiquid. I have to wait for them to trade it. I think that helps people who want to diversify, don't you?
No, I agree. Because I think there's not a whole lot of real estate investors that sit back and say, I wish I would have sold those earlier. Almost everybody says, I wish I would have held on to those. And being kind of emotionally driven folks, as a lot of us are at times, the fact that it's passive and you don't have control or voting rights and you can't make an emotional decision to sell abruptly, that can actually help you quite a bit.
Yeah, I find that part very helpful for me personally as someone who's flipped a lot over my life and enjoys flipping when I'm selling and hates it every day while I'm doing it. Just like same BRRRR strategy, like, oh, great. I don't like talking to contractors. I need a buffer in there. But I really, like we were saying, I really like that I can't have an impact. But that means that you have to be really good at your due diligence up front. When you first got started with passive, there wasn't as much information out there. How did you make sure you were doing the due diligence? Because I know on the turnkey you missed, and a lot of people have missed on the due diligence for syndications in the last few years.
Yeah. Yeah. So I made some of those early mistakes that you hear a lot of people make. That, as I mentioned, that first passive investment, I just invested with a guy who had a big podcast, who had a big brand. I assumed he was too big of an organization to fail.
Yeah.
And he had done amazing things up to this point. So I just assumed that all would go well. That due diligence process early on was really, really minimal. And I would not encourage anybody to do those type of emotional investments in the passive investing space. There's a lot of salespeople in this space that are really good at presenting, the best case scenarios to investors without sharing like the true downside. So yeah, it's evolved a lot. I mean, I have 110 plus point process I go through to vet deals today. And it's a lot of metrics driven, but mostly it's historical. What have they done historically?
Yeah.
How long have they been in the space? A big piece that I spend a lot of time on is really analyzing their current portfolio. There's a lot of operators out there that are pitching new deals, but they've got a bunch of assets that they probably bought wrong, put the wrong debt on back in 2021 and 22.
Yeah.
And a lot of those deals are going sideways. And even though the new deals look great on paper, if you are a business owner and half of your business is sinking, half of your business is still sinking.
Yeah.
I don't care how good the other deals are. So really, really important to understand what's going on with their current portfolio.
Yeah, I don't think you want to buy into somebody who's saying, oh, well, 5 of these 7 aren't going well. But it was just, it was a bad buy. Well, I mean, the whole reason why we trust you with their money is to make a good buy. So we all make money. Don't buy with floating rate debt, and those are the things that honestly most people don't know. And again, like we were saying, you're really excited when you decide, hey, syndication seemed like a great option, that it is easy to just hop on board because there's a lot of tremendous marketing out there, as you said. But that doesn't mean that it has the systems that you need. I too look at how many deals they've closed, how many have gone full cycle. And then for me in particular now, especially because of the rates, I'm just looking at what debt they're carrying. It's so important to me because everyone who's in trouble is generally because it's floating rate or bridge or something like that, or some type of alternative, 1 year thing. That's the entire problem. Most of the ones that were bought with fixed rate debt are able to go through no matter what. It's, maybe they made a bad call if they're doing value add, but I'm not investing in value add right now.
Well, it's interesting. Like I agree with you 100% wholeheartedly. Debt is the single biggest risk factor in any deal that you do. But there were a lot of people doing 5 and 7 year debt 5 and 7 years ago.
Yeah.
So if you're having to refinance today, hopefully, if you did buy 5 or 7 years ago, that you've got enough equity in there, and it's not going to be as good of a return as it could have been, but you still, everybody took a haircut in the last 2 years.
Yeah.
So that's important to look at too.
That's a great point because a lot of syndication debt is a 5-year window just because you get a good rate. It seems like you can sell within that time frame. But yeah, if you get to the point and you can't get out and you started at 3 and you're going into rates now and you have to refi, it's a huge problem. And I think that's a great point to make because it's not just, again, though, that's still knowing the market. You have to have something that's producing at a level where hey, rates could go up. I mean, nobody should have thought they were going to stay at 3% for that long. That was good saying.
Yeah, no doubt. But at the time, if you were listening to podcasts and talking with operators, there was a big population that was convinced that we were going to see interest rates stay the same or potentially go lower. But it's interesting. The people who I'm wanting to partner with today are the guys that sat on the sidelines for the last 3 years.
Yeah.
And they're starting to come off the sidelines now because their deal flow is starting to improve. New opportunities that I think there's going to be, there are going to be deals that go south, and that's going to create opportunities for investors today. So,
yeah. I think the people that were waiting or just doing way less volume than they were when things were easier are perfectly primed to be able to jump on a lot of opportunities. And also, those are the people that the contacts relationships will look to sell to because there's a subset of people who aren't getting sold to. They either don't have the money or they're not reliable to close based on their history now.
Yeah. Yep, absolutely. Yeah, it's interesting. I had Brian Burke on my podcast
Yeah,
4
me
or
too.
5 months ago,
Yeah.
and he's like the naysayer to everybody, right?
Yeah,
Doom
yeah.
and gloom,
I mean,
like the sky is falling.
he loves that role. He loves that
Absolutely,
role. Yeah,
absolutely. And I think we need that out there as well.
yeah.
But I challenged him though too. Like if you were, because he had tremendous success, lots of years, decades of success. But if he was a new real estate investor 3 years ago, what would he have done? And he says, transparently, he might have made some of those same mistakes. So, there is always opportunity no matter what market you're sitting in. It's just a matter of getting creative and finding the right opportunities that fit what's going on in the economic cycle. So,
yeah. And I mean, I think that a lot of people want to make passive investing sound risk-free, and there's risk inherent in real estate. To me, it's extremely limited risk and very easy to take educated risk. But you have to know, like, some things just may not go your way, especially the more deals. You're just not going to be at, you're not going to bat 1,000. That's just kind of silly.
Yeah. It's interesting. When I first came in, I was kind of the same mindset that, you're not going to ever lose money in this space. You're not ever going to have capital calls or pause distributions. And, fast forward, I'm in 25 deals, and I will likely be losing 100% of capital on one of the deals that I invested with a couple of years ago.
Yeah.
I have paused distributions on about half of my own personal investments.
Wow. Yeah.
And there are some challenges in that current portfolio. Now, fortunately, the deals that I've partnered with on operators and raised capital on, that portfolio looks really strong.
Yeah.
So it comes into that diversification strategy where, yes, we want to diversify across deals and operators and asset classes, geographies, and all that other stuff. But you also want to diversify and deploy capital over a window of time as well during different market cycles. So that was a hard lesson for me to learn because I deployed a large portion of my capital potentially at the wrong time. So
yeah. I think that's interesting, though, because I think of it when people talk like that, I think of startup investments, because people who invest in startups and do VC, venture capital, like they'll invest in 100 things and only one needs to hit. That's what's crazy about it. You can just have one become meta and you become like a millionaire if you have enough shares. So it's understanding the diversification, that it's okay if a couple don't do as well. Of course, you don't want pause distribution and capital call and a collapsed fund. But if you're leveraging yourself the right way and investing, like you said, and like you do in several different asset classes and at different time periods, you're really hedging your own portfolio against itself. So it's just overall safer as one big portfolio.
Absolutely. Absolutely. Yeah.
Hey, it's Jonathan. I hope you're enjoying this episode with Randy Smith. And we are just turning the tables because my episode on Randy's podcast, The Gentle Art of Crushing It, just came out on March 27th. So if you want to look that up, again, The Gentle Art of Crushing It, look up episode 252. I'm the guest, not the host, and it's called How to Build Your Passive Buy Box with me. Let's flip the script and get back to Randy. It must have been interesting for you, though, because I know you've invested, I think I was looking in at least 8 asset classes. That's a lot to trust other people to do, because you can't do full due diligence on the whole asset class for all of those. That would be impossible.
Yeah. Yeah. So like general principles apply across, multiple asset classes, just investing as a whole, right? When you start looking at affordable housing, that includes a lot of different things, multi-tenant, a lot of similar trends, whether it's people or self-storage or mobile home or whatever that is. But you're absolutely right. I think I early on diversified. The mantra was trying to diversify as much as I possibly could.
Yeah.
Across different asset classes. And I know now that I probably need to focus in on 2 to 3 asset classes and just stay very, very close to those.
Yeah.
And my ultimate goal is to have the very large majority of my real estate investable capital probably with 4 to 6 operators.
Yeah.
Because it's hard to keep track of 20 plus operators as well. So there have been some hard lessons learned there, but lessons that put me in a position today to be able to make much, much better decisions when I'm looking at the next investment.
Yeah. And I think that's good advice for new investors who are trying to figure out which asset class will work for them, no matter what it is. Like you said, when you tested out BRRRR, it's like if you try something for 6 months or even research it and decide it's not for you, that's not lost time. You have a ton of information that you can bring to someone else. So, if you invest in one self-storage syndication and it does okay, or it's just not your bag, you just wait for it to close, which is what we were saying before. You got to wait it out and then say, you know what, when I redeploy that, it's not going to be into that asset class, but at least I gave it a try. I have a little bit more information on it. And that also goes to knowing more people in the space, I suppose, as you got going. And of course, you're investing in, more than 20 syndications. Now you have all these relationships built so that when you go to the next level on all those 20, you have so many options of where you can put those on 1031 to redeploy.
Absolutely. Yeah. And I think to your point, like the community that you build around your investment strategy is just so important.
Yeah.
Not only the operators that you deal with, but the investing community as well. So the best possible way to find an operator is through somebody you know very well that's already investing with them and has for years and years. So I will only do deals with people that I get referred to and that I sit on the sidelines and watch for a long time because I want to see how they show up when things go south. Because maybe not south, but when things get hard, because things will get hard. Nothing ever performs like a pro forma, that's for sure.
Yeah, I want to get your take on this because it's something that's kind of aggravated me over these 231 episodes. So I've had tons of people in all different, syndicators, story, everything. But the thing to me is, what tells me a lot is if I get off and I'm interested, which happens a lot, I have great guests like you I'm like always charged up afterwards. I want to have a conversation. It's like if that first conversation then goes and I get to just some like intake person, I'm so annoyed. Yeah. You know what I mean? Like I'm not, not that I think I'm special, but like we literally just talk for an hour. If you put me into the funnel with everybody else right afterwards, I feel like that's not a good fit for me. Do you know what I'm talking about? And does that bother you as well?
Yeah. And well, it's interesting because I'm writing much bigger checks now because I'm bringing not only money from my investors, but quite often I'm partnering with other capital raisers as well. So I'm bringing $1.5 million plus to deals. So I usually have a direct contact from day one. I don't know. It's a balance, I think, because you want an organization that's big enough that has track record experience and has internal resources.
Yeah.
Because, at the end of the day, do you really want Brandon Turner talking to the $25,000 investor, or do you want Brandon Turner focusing on the relationships and building the business? So
a great point both ways, though, because if I'm the investor, I want it, but if I'm the company, I don't want it. So it's a hard line to follow. Obviously, at scale, you have to scale out of that, but I mean, there's still syndicators who I can talk to about it regularly, but it's a really good point. And that it's something for investors to know. It's what kind of experience do you want? For me with syndications, because I know I'm not going to have any control later, I want to at least have a better one-to-one up front. But as you said, if the organization is set up in a way where you're not getting on with like a VA to start off, and it's just like, director of acquisitions, that's fine. I'm just saying, like, sometimes you get on the first call and it's just like, you clicked on a Facebook ad or something and it's like, what? But that's a good sign to what we were saying before and probably mistakes that you may have made in the beginning. It's like, it just looked good and it sounds good, but I'm not really getting the information that I need. It's just, like you said, best case scenario, which is a disaster when you're trying to vet syndications.
Well, yeah, and I think it's good to understand what your own personal preferences are. Like if you like dealing with, John Doe, and he's the face of the company and he's the guy that you talk to, you're probably not going to deal with an operator that's got $1 billion in AUM, right? But you could potentially deal with an operator that's got 50 to 80 to $100 million in AUM.
Yeah.
And there seems to be this sweet spot where there are operators that, believe it or not, there are operators that don't want to take over the world and own $10 billion in AUM and become the next Warren Buffett. There are guys that literally, they want to own 200 or 300 units or 500 units, and that's enough.
Yeah.
And there's quite often, they're sometimes the very best operators that you can possibly ever find, and they're not out advertising.
Exactly.
And,
they have a wait list anyway. They don't need to advertise. Yeah.
Absolutely. The very best operators, they don't even need any additional investors. So they've got very little client facing stuff. It literally is, I call them like the country club type groups, because literally they share their dealers, they're full in 2 days.
Yeah.
And I mean, you almost have to sell them
Exactly. That's
why
great,
you
though.
want to invest in their deals. Yeah,
Yeah,
exactly.
right. If you're a stranger and not on referral, it's very hard to get in because it can be risky. You don't want to, as a syndication operator GP, to have someone who then gets in and doesn't understand the model and is now wanting to call every day to discuss, what the distributions are. It's like,
Oh,
no,
gosh,
we
yes.
created this model, so there's no conversation about that. Just read the monthly. But yeah, these are great points, and I think these are things that new investors and seasoned investors who haven't gone into more passive investments need to think about and investigate before. And it's harder now because the social media just makes everything seem like it's a home run, on that best case scenario. And there's way more due diligence needed. Not to say it's impossible, but it just requires a little bit of a magnifying glass to just make sure you're hitting the top items, that at least you're hedging bets on educated risk to be safer.
Yeah, absolutely.
Yeah, let's talk a little fund of funds, because I know that's part of what you're involved in. I don't think everybody understands what a fund of funds is and how it works in terms of you bringing other people's investments with you into syndications as a group.
Yeah. So it's kind of this emerging thing. I would say certainly over the last 5 years or so, we've seen more and more and more of this. In the last 2 years, we're seeing it progress even more, and big communities popping up around it. But ultimately, like my path, I mentioned, I was in sales. I was investing very heavily in these. And being a sales guy, I was telling everybody that I knew what I was doing. If you stood next to me for 30 seconds, you were going to hear how excited I was about my investments, right? Yes, I'm that guy, right? My biggest asset and my biggest weakness all in one. So anyway, I started having friends come to me and say, hey, how can I get involved in these deals? So I went and talked to one of the operators that I work with and said, hey, I'd love to make referrals, and I'd like to make a couple of bucks doing that as well if I can. Because obviously that's valuable to him to make those intros, and it's valuable to my investor because I already have experience. And they presented this idea of fund of funds or SPVs or feeder funds to me. And essentially what it is somebody like myself, we actually set up a fund. I generally will do single asset funds where it's very clearly identified that if you invest with me, we are going to pool those dollars and then place that capital into a very specific deal,
one property,
an asset. And we've done multi-asset ones with like 2 or 3, but we've never done blind fund. Blind fund being
pick up one, wait, pick up another. Yeah, I understand. Yeah,
exactly. Yeah. So by pooling these dollars, the investors are invested with me, and the benefit to them generally is that I am doing a ton of due diligence, finding only the best opportunities out there. I do this full time. Yeah. And then additionally, I'm usually getting much better terms from the operator because I'm bringing them a much bigger check. Yeah. So if I'm bringing $1 million to somebody, I'm going to get better terms than somebody who's bringing 25 or 50 grand to the table. Yeah. So more often than not, my investors will get either the same or better returns through me, and they get to take advantage of all of my vetting and my years of experience as well.
Yeah, I mean, a fund of funds is kind of like syndication arbitrage, I guess. I mean, it's because it's a middle person, but again, it allows for that initial investor to trust one person to do, the option. And I think it's important to note, though, we were just talking about the funds, and a lot of times funds can be open-ended, as you were saying. So you can invest whatever money, and they're going to slowly figure it out, and you're going to get a return. But you guys are taking and investing into one deal, which could be multiple properties, probably the same seller on the properties. So it's just one portfolio deal. So at least they know we're investing in a fund, and then that fund is going into one deal together with all the people that are in the fund of funds.
Exactly. Yeah. And I think, in this space, there's different types of investments. It's either those type that are only available to friends and family, or the type that you can actually publicly advertise. Yeah. So by working with a fund manager like myself, I have those relationships with dozens and dozens and dozens of operators. So they like working with me because they get access to my network. Yeah. And, the benefits go both ways. So.
Yeah, and that's a perfect fit for your sales skill set as well, because you have both. You're doing it both ways. So you want the person with the relationships to be in that middle part, so you can have both parts of that. And I think of it like in 1031s, when you use an intermediary, a lot of times that intermediary has all the contacts on where you can park your money next, instead of just choosing randomly off of Zillow. You're trusting
Sure.
the operator in the middle who's built those relationships both ways, so that they have people with money coming in, and then they have places for it to go out.
Yep, absolutely.
Yeah, it's really interesting how syndications have progressed, because growing up, I had never even heard of them. I don't even really know that they existed or not. But again, as I got through my career and then found, bigger pockets 10, 12 years ago, I think I shied away from in the beginning because I thought, ego, like, I just do this all myself. I'll just keep flipping. Until you realize, like we were saying, BRRRR and flipping is just annoying.
Yeah.
It's a lot of work, and it's basically having a full-time job for one property at a time, or however many you're BRRRRing.
Right. Absolutely.
Yeah. I mean, it is, you got into syndications pretty quickly. If someone's out there now and they have good income, disposable money to spend, but they don't want to spend it on a single family house, or they own a single family house, what would you recommend based on your experience going through all of it? And, talking about the market now today, what would you tell someone? Because I think what I would recommend is changing every year. It's different each time as we look at rates and opportunity and inventory.
Yeah, so I think there are certainly market cycles, and there are better opportunities, better times to get into the market. I think for folks that are coming into the space now, it's a really good time to do exactly what they're doing. If they're listening to podcasts, they're starting the education journey. And then I generally just say, like, try to get on the phone with as many operators as you possibly can. Start dedicating time to education. I have on my website that 110-point due diligence checklist process.
Oh, awesome.
I share that with anybody, right? So go out there and find all the free giveaways that everybody has, and you can start your education journey there. And then at some point, you got to pull the trigger and put some dollars into play, because all the studying and researching in the world is not going to ever teach you as much as going down to the bank and wiring a few dollars and seeing what an investor update looks like and getting a distribution and dealing with K1s and all of that other stuff. But I would urge folks too, like, don't set the goal to go out and deploy a ton of capital in a short amount of time. Like, if you've got $200,000 or $300,000, maybe put 50 grand in a couple of deals this year, and then next year maybe 50 or 100 grand in a couple of deals. Because you don't have to have a ton of money at play for this to have a pretty big impact over time.
Yeah, if you're patient. That's fantastic advice, though, because I think I've always found that the push, at least social media and marketing wise, is taking action means buying or investing, but it's not. What you said exactly is get educated, listen to podcasts, build relationships. That's taking action to me, because if you take action the right way, podcasts, meetups, relationships, books, put those all together, you're going to have much more confidence than if you're just watching YouTube all day and, thinking that everybody's telling you the truth. It's really but you have to know that you are taking action when you do that, or else you will get stuck in that analysis paralysis state, because you're just like, oh, I'll just vet, 50 syndications. You're never going to choose if you're looking at 50 and you don't even know what you're doing yet. You're just looking at, all these documents with 10, 30-year projections that, I skip those parts.
Right. Yeah. And I think just as important is get around other people that are doing what you want to do. So if you want to be a passive investor, go find passive investors. And you might not find those at the local RIA, because those are generally active investors. So there's a lot of online communities. There's a lot of conferences. And just listening to podcasts, you're going to hear there's tons of podcasts that are just focused on passive investors.
Yeah. So, I mean, you listen to everything, with a grain of salt, because there's, a lot of times there's a pitch. A lot of us don't have a pitch. We just like to do this because it's fun. But, and also a pitch is okay, because every time that somebody comes on, we want to make sure that we're publicizing that. But I think we also have to take responsibility for our own due diligence. And as you were saying earlier, like, look, those were your mistakes. I've made so many mistakes, on just either trusting too soon or picking the wrong thing. But I don't feel bad about it, because it's all part of the journey. But also, I don't want to, as you were just saying, I don't want to take the whole chunk and just put it on one thing. That's why syndications are good. If you're accredited, you can take 50,000 pops and drop them in. And as you said, you don't have to do it right away. Relax, make
Yep.
sure that you feel comfortable enough to go, and then eventually take a ride to see what's going to happen.
Yeah. And I would even say, even if you're not accredited,
Yeah, for
there's
sure.
plenty of 506B non-accredited opportunities out there.
Yeah,
So,
yeah. There's a lot of group funds and group investing that work on lower levels. And those are ways, again, you'll find those much more building relationships with people, instead of surfing social media to find out,
Exactly. Yeah.
everything looks like the best deal out there. Before we hop off, so when you're looking to invest, with people in a fund of funds, you're going to take money together and place it into, what are like the three most important things you're looking at when you're looking at a deal? I know we talked about debt before, and the debt on the deal, I'm sure, is one of them. And what are the other two that you would say are just non-negotiable? They have to really be a yes for you to make sure that you're going to pull the trigger on that deal.
Yeah. So to your point, yes, debt is the number one risk. So debt first. Secondly is track record. How long have they been doing this, and how long have they done what they are claiming they're going to do on this one? And I think it's really important to note that you don't want to work with folks that were only involved in this space for the last 5 years or so.
That's a great point.
Anybody with a pulse could have bought an asset and made money on it.
2020, everybody was a winner. Yeah.
Absolutely. Absolutely. Okay. So those are the two. And then three, I always say, well, can I give four?
Yeah, please.
Okay, perfect. So three, I'm going to say, dig into their current portfolio and make sure that it's performing, not necessarily as planned, but make sure that it's performing and there's no risk of loss of capital.
Yeah.
Okay. And then finally, now I said I was going to say four and I can't think of it. Well, we talked about debt already. I was going to say positive leverage. So just make sure that the debt and the interest rates and the cap rates line up how they should align. So
and trust your gut. I mean, sometimes you don't know what your gut's saying, but if it doesn't feel right, then just trust that. Because to me, if you're taking a lot of money, no matter how much you have, if it's a lot of a percentage for you, you just want to feel good about it. Sometimes, like we were saying, you can get overexcited and make a bad decision, but at least you were excited about it. There's nothing like more annoying to me than somebody says, yeah, I just invested in X. I'm not really sure about it.
No doubt.
Why'd you do it? You don't have to do it. The pressure is there to wait for something that at least feels good when you put it in. The operator seems good. That seems good. You can still make a mistake, but at least you're, again, trying to choose something that's going to be more pleasurable and not a headache later on.
Absolutely. Absolutely. Yeah. And I would just add, trust your gut if it's telling you something negative. But if your gut's telling you this is the greatest thing since sliced bread, verify. Right? Trust but verify.
Yes, it's a great point. Because you just may not know what you don't know yet, and
exactly,
you could get excited about it.
We all fall victim to sales skills.
Shiny objects are really cool. you just, when you buy them, you realize they break in a day. So it happens.
Yep, exactly.
Yeah, awesome, Randy. So tell us a little bit about Raise Capital Coaching and Consulting and what you help people do inside of that.
Yeah. So basically, like my trend in my whole career was do something, get good at it, then teach people how to do it. So I did that in corporate America. I did that with my passive investing, and I continue to do that. And now, as it turns out, as you get good at capital raising, everybody and their brother wants to talk to you and learn how to do it. Yeah. So I put together my RAISE strategy, the RAISE, which is helping teach people everything they need to get started on their first capital raise. And I'm calling it 5 steps to $500,000 or more. So the R is relaying your story to your target investor avatar. The A is attracting through LinkedIn. I use LinkedIn because that's where my avatar hangs out.
Yes.
Yes, definitely. I is the identifying partners and operators, so due diligence. The S is how you structure those, like what are the fund structures to use? And then finally, the engage process through email marketing, CRM, and investor portals. So literally, somebody who's in a W-2 role that wants to get started in this space can do the training and literally be raising capital for somebody else's deal within 90 days.
Yeah, it's kind of crazy to me that people who want to go big and make big relationships spend time on Facebook as opposed to LinkedIn. It's like the people with the money are all on LinkedIn, and they don't sit there and post. Nothing wrong with people posting pictures of their pets. I do it, but whatever. That's
Sure.
not what I'm posting on LinkedIn. LinkedIn.
Sure.
There's more spam on there than normal now, but it's generally a business site where CEOs and business operators are. So it's a better pool of people than Instagram or Facebook, even if that's enjoyable. It's a different level of operation than where you can make better connections, I think.
Absolutely. Yeah.
Awesome. Randy, is the best place for people to get in touch with you and find out more about what you guys do at impactequity.net?
Yeah, so that's the best route if you are a passive investor. If you want to learn more about the coaching options, the website is raisecapitalcoaching.com. And then, of course, the podcast, The General Art of Crushing It.
Awesome. Well, I appreciate Randy. It's been a great show. I like talking syndications, but your journey is really interesting to me because so many people, you did do some BRRRR and some, but you got into syndications pretty quickly as an LP and went into a lot of them. And I think that's a strategy more going to employ. But if they take your advice about the things that you did wrong on doing it and they whittle it down to 4 to 6 operators, I think that's a great piece of advice that people can take with them.
Awesome.
Yeah.
Well, thanks so much for having me on the show. This has been a lot of fun.
Yeah, absolutely. That was Randy Smith, the founder of Impact Equity. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. Episode 232 next time brings Paul Shannon. He's the co-host of Passive Pockets. Now that's Bigger Pockets' new syndication podcast. Paul has acquired several hundred units by recycling equity. But the most important part, and what we talk about a lot, is Paul is an LP, which is a limited partner in over 40 deals as a passive investor. This is how he got to Passive Pockets, and this is what he's bringing next week, as well as what he does at InvestWise Collective. We'll see you then.